Welcome to The Explainer. Today, we're doing a deep dive on Edenred.PA, and if you're a stock market investor, we're going to try to figure out how this global payments giant really works, and more importantly, if it's a smart place for your money right now.
We're going to approach this just like an analyst would, using a 5-step framework. First, what exactly is this business? Second, how does it make money? Third, where's the future growth coming from? Fourth, what could go wrong? And finally, the big one, is the stock on sale? All right, let's get right into it. Section 1, what is Edenred? What is the core business here? At its heart, Edenred is what you'd call a massive three-sided marketplace. It's the critical middleman. It connects the companies that want to give out perks, their employees who get to spend them, and all the shops and restaurants that accept those payments. Now, from an investor's perspective, this is just a beautiful model. It's a value loop, where each side makes the other stronger. The more companies sign up, the more merchants want to join. And the more merchants join, the better the service is for employees, which, you guessed it, makes even more companies want to sign up. That's a powerful network effect right there. So where's the revenue actually coming from? Well, no surprise, employee benefits make up the lion's share, about 2/3 of the business. But you really can't overlook that mobility segment. Fleet solutions, that's a huge piece of the puzzle and a major engine for their growth.
Okay, so the business model looks great on paper, but do the numbers back it up? Let's dig into the financials.
What these numbers really tell you is a story of incredible consistency. Look at that clear, upward line for both revenue and profit. And this isn't just during the good times. It's straight through different economic cycles. For an investor, that kind of all-weather resilience is exactly what you want to see.
And if you zoom in on the last few years, you can see that growth has really hit the accelerator. The top line isn't just growing. The pace of that growth is actually speeding up, which is a fantastic sign.
Now here's the best part. The profits are growing even faster than the sales. This is a perfect illustration of what they call operating leverage. Once their digital platform is built, each new dollar of revenue costs them very little to handle. So more and more of it just drops straight to the bottom line. It's a beautiful thing.
Okay, this brings us to one of their secret weapons, and it's called the float. Edenred gets paid by its corporate clients long before it has to pay the merchants. So they get to hold on to this huge pile of cash. And what do? They invest it. Last year, that float generated a staggering 247 million euros. It's the same principle that makes insurance companies like Berkshire Hathaway so profitable. It's a hallmark of a truly fantastic business model.
And what's the result of all this? Edenred is an absolute cash-generating machine. Over 70% of its earnings turn directly into free cash flow. That proves this business isn't just profitable on paper, and as any investor will tell you, at the end of the day, cash is king. The past performance is obviously strong, but as an investor, you're not buying the past, you're buying the future. So where is Edenred's growth going to come from next?
Well, management has laid out this beyond plan, and it's pretty much a three-pronged attack. The foundation is scale the core. Just sell more of what they already do really well. But the really exciting part is extend and expand, diversifying into new services and making a serious push into new places, like the US. And they are putting serious money where their mouth is. This massive 1.3 billion euro acquisition of Reward Gateway, that's not just about adding a new product. It's a really strategic move to transform themselves from just a benefits provider into this all-in-one platform for work life. This is how they plan to build a wider competitive moat and keep users totally locked into their ecosystem.
Okay, but no investment is a sure thing, right? There's always a catch. So what are the potential headwinds here? What could derail this whole investment thesis?
I think the biggest long-term question that every investor has to grapple with is this. Could some small, fast-moving tech company just come out of nowhere and completely disrupt this entire model?
You know the type. These tech-native players, they're brilliant at product design, and they can come in and just attack these little specific niches inside Edenred's bigger portfolio. They are the classic disruptors.
But Edenred isn't just sitting there. They have a three-part defense plan. 1, build their own all-in-one super app. 2, just buy the innovators. And 3, turn would-be competitors into partners. It's that classic strategy. If you can't beat them, buy them or join them.
But the most immediate threat, and honestly, a big reason the stock has been struggling lately, is regulation. A single government decision, like this proposed commission cap in Italy, could literally wipe out 60 million euros in profit. And that kind of uncertainty is something the market absolutely hates.
Okay, let's move on to the final question for any investor. After we've looked at the business, the risks, does the current stock price actually offer good value? Is it a buy?
So how does the market value Edenred compared to its competition? If we use a common metric, EV to EBITDA, which is basically a price tag for the whole company relative to its cash profits, we see a really interesting story. Edenred trades at a huge premium to its main rival, Pluxee, but it actually looks cheaper than some others, like Corpay. Context here is everything.
That big gap between Edenred and Pluxee, well, that's the price the market is willing to pay for Edenred's bigger scale, its better growth history, and its higher profitability. Simply put, you're paying up for quality.
And check this out. There's this cool test that's usually saved for elite, high-growth software companies. It's called the Rule of 40. You just add the revenue growth rate to the profit margin, and if it's over 40%, that's considered excellent. Well, Edenred scores a 47. That's the data telling you that behind the scenes, this company has the financial engine of a top-tier tech stock.
So it all boils down to this one crucial question for any investor today. Are you looking at a high-quality company that's just facing some temporary problems, or have the rules of the game in this industry permanently changed? That is the multi-billion-dollar question you have to answer.